Welcome to the pod before the pod, the meeting where we talk about the real meat of the matter. Guys, I am so excited about this week's episode, but then like the ones coming up, I'm really, really proud of. But to get ready, I need you to do a little homework. This book, Funny Money by Justin Anderson. He's a friend of mine from the industry. He founded Rent Smart and has a really interesting story. But I want you to read this book because we're actually going to do a two-part episode with him coming up later this summer. He talks about a couple of things that are really interesting. One, he's got a really incredible story of building his own portfolio and starting with nothing and growing it to like 800 doors, something like that. And also why he scaled it back and made more money. Fascinating tale. But he talks about the life cycles of properties, neighborhoods, and then the market life cycle. This is something I know intuitively that I talk about in my business, but the words he put to it and it just has changed the way I think about it and how I talk to investors about it. I think that's worth the less than $20 book. But also his discussion of price versus value in real estate, right? We all know that the prices, the dollar prices of real estate have been inflating incredibly over the last like 30 years. And he talks about why that is, but also looks at price compared to value because value is not necessarily price. And he does this with a really interesting project where he maps average real estate prices to gold, to ounces of gold based on the prices of gold at that time. And the conclusion, long story short, is we actually are looking at real estate being tremendously undervalued today, despite its prices being higher than ever. And if that's boggled your mind, read the book, listen to my two-part conversation with Justin Anderson. In fact, put Justin Anderson in your podcast player and search for him. Look for where he's appeared on other podcasts, because that's actually where I discovered this gold discussion he did. Anyway, I can't endorse it enough. And if you look in the description for this podcast, I'll put a link to the book. All right, if you're getting the newsletter, and if you're not, what the hell are you doing with your life? Get my newsletter. Links on HoldItwithPMJen.com. I made PMJen's Pennsylvania legislation tracker, and I'm very interested in knowing what sort of legislation is coming our way as housing providers, investors, things like this. This tracker is tracking 40 different bills and talks about what they're doing, gives you links to the actual bill documentation, and tells you where they are. But there are 6 that I specifically want to cover with you. They're the closest to being passed and I think have some of the most applicability. Now, listen, if you're not in Pennsylvania, you very likely have legislation just like this in your state if it's not passed already. All my friends on the West Coast tell me, do not ignore this. Do not sleep on these little issues because they turn into big issues really, really fast. All right, we're going to start with HB 2186, and this is about ADUs. And I personally love this one. What it does is it makes it easier to build ADUs on properties. ADUs are smaller secondary homes on a property. Think like a backyard cottage, a converted garage, an in-law suite, even like a tiny home. People are buying these like, I don't know, like $20,000 jobbers on Amazon and plunking them in the backyard. But most of the time, the municipality's rules are this is not permitted unless we've made a special exemption. And what this law would do is reverse that, is say, hey, generally ADUs are allowed, with the exception being where there really is a good reason not to. Now, that addresses a couple of things. That addresses housing affordability, housing availability. It also does something really rare for us investors, which is makes our property more profitable by giving us more options for how to monetize it instead of less. So keep an eye on that and what that looks like. And by the way, that one is all the way through the House. It is cleared the House. It is now going to the Senate. And of course, the Senate would need to take it through its paces, and then the governor would need to sign. HB 2109, this one prohibits occupancy limits. So municipalities generally will set occupancy limits, and those rules will cap how many unrelated people can live together in one home. And you've heard of this. The most common application is in towns where there's colleges, right? You'll hear these rules about no more than 3 or 4 unrelated women or persons living together. And this is all about trying to restrict certain kinds of housing and activities that people in these municipalities wanted to make rules against. This would prohibit those sorts of things. It would open the door to more shared housing and like rooming house situations to, again, allow for more housing affordability, more housing availability. We're 4.5 million housing units short in this country. This bill and the ADU bill, I think, directly aim to address those concerns for the American people. This has cleared committee and appropriations and is at the floor vote stage in the House, meaning that they have to take a vote, and that is the next step. And of course, if it passes the House, it moves to the Senate, and then our governor would have to approve it, sign it. This next bill is actually two bills. They call them twin bills. One comes from the House and one comes from the Senate. So I'm talking about HB 558 and SB 1216. Both of these aim to address rental application fees, the application fees that we, landlords, property managers, charge tenant applicants in order to process and underwrite their application and determine if they are creditworthy enough. And so the allegation, what they seek to address here, and both these bills mention it, is that they believe that housing providers have made application fees a profit center. And speaking as a housing provider, it's not a profit center. We calculate how much it costs us to process an application, and we do have the hard costs with the company that provides the criminal screening report, the credit screening report. Even we're doing more advanced screenings where we actually get bank authorization and download information from the bank in order to verify the income sources that the applicant's giving us. So we have hard costs there. We do a lot of work to get these applications in full received. I have to tell you, getting applications completely received by applicants is a very laborious task. In the imagination of these legislators and the activists, we just sit back collecting $65 a pop application fees, and we're just drowning in application money. And that's simply not true. Now, there is a profit center baked in here because we are paying the bills for this other company to provide us this hard data, these reports. Those companies are making a profit margin. So even if my hard costs in that are $45 an application, that only leaves me $20 per application left to do everything else, which is often a manual call to housing providers, verifying all of that, multiple phone calls, emails, text messages back and forth with applicants to actually get their good identification and supporting documents. All of that has to be done. And so I think the allegation that we're, as housing providers, making money off of these application fees, that isn't true. But what you can look for is, like, what will change is more of us will be using end-to-end application providers. So instead of me having somebody in-house underwriting these things, we'll be farming it out entirely. That might cost, I don't know, $80, $100, but I will have a legitimate invoice to match to the application fee that I collected, showing whomever that I'm not making a penny on this. This is something where I really happen to disagree. I get the intent. I understand the intent. I think it's a fundamental misunderstanding of how we're running our businesses. So the House bill, HB 558, has passed the House and moved to the Senate, where it's sitting in Urban Affairs and the Housing Committee. SB 1216 has not gone through the House yet, so it is not as far along, but both aim to do the same very thing. Next up is HB 72, and this addresses tenants' rights in the case of violence. This has been a difficult one. In fact, there was a lot of tension between national advocacy groups, the Apartment Association, and the Property Owners Association over the final language of this. And you can imagine why, because it addresses letting a tenant break their lease and move out without penalty if they, a household member, or others are a victim of violence or are aware of violence near the unit or building. And the goal of this is to give victims a fast exit without being trapped by the lease term or hit with burdensome fees. But from a really practical concern, this means we have institutionalized with the system in some cases, overreactions to things that are happening. And so we do already have the Violence Against Women's Act, which gives some really great protections to people who are suffering from domestic violence and things like that. But as long as violence is a thing that happens in the world, this isn't controllable by the landlord. And it's my personal belief we shouldn't be allowing contracts to be canceled or have their teeth taken away because someone is scared of violence around them or scared of violence happening in the building. It's just too easy to claim that. And maybe I'm not understanding properly where there's vulnerabilities for this population, but as written, I am anti. But this has gone through the House and has moved to the Senate, and it's working toward appropriations. So it's about halfway there. Next up, HB 734, tenant relocation. So addressing who pays when a unit becomes uninhabitable and the tenant has to move out either temporarily or permanently. So imagine there's been a fire in the unit and it's not currently habitable. Who pays for that tenant to have different lodging during that time? The original version of this bill put all of the relocation and housing costs on the landlord. It's since been amended to reflect that they assign costs based on fault. So if the tenant has some negligence or cause to the issue, let's use an example. They did not supply heat as required in the lease. The pipes froze in winter and the unit flooded. Okay, that home is no longer inhabitable, either temporarily or permanently, while the repairs are made. In that case, I believe this bill would assign fault to the tenant and therefore the relocation and housing costs would be theirs. But in a situation where, say, for instance, there's just a normal maintenance issue or there's a fire or an accident. Okay, here's a great example. And I've had this one more than once. A car drives through a wall of the property, right? That property is not inhabitable, requires a lot of fixing, but that is not the fault of the tenant. And that would, in this case, I believe, viewed as the responsibility of the landlord. Um, This is something that I believe insurance is best set up to cover. I do not believe that landlords are responsible for providing housing. Who determines what's habitable, what's not? I would rather see us use insurance for this, and that's certainly been the approach of my company, One Focus Property Management, now providing property management services to you in North Central Pennsylvania. All right. And the last one. This is another case where we've got two bills doing kind of the same thing. I'm going to tell you about them both. HB 1095. Now, this is referring to limited access regarding eviction information, and HB 1492, which is specifically about criminal records being used to screen tenants. We'll start with the criminal records used to screen tenants, only because this one's kind of parked right now. The sponsor of the bill, Representative Siegel, has resigned. And so it's lost some momentum, but the idea here is that they were going to restrict how criminal records could be used when screening rental applicants. Now, I've done a lot on this. If you listen to my ESA episode a couple weeks ago, I talked about how disparate impact has been guiding us in these decisions and using criminal records. And now, of course, the administration says disparate impact is a bad word. We don't talk about this anymore. So as you can see, states are cropping up and states are saying, hey, if the federal government isn't going to address this, we're going to address it. So the idea here is that the past criminal record can really go against somebody applying for housing, and that we need to be very careful about which ones we're considering and things like that. And so I'm not that scared of this bill, quite honestly, having lived through the last 10 years with the disparate impact stuff, but it is currently parked. It hasn't gone through the House yet. Let's talk about HB 1095, and this talks about limited access to eviction information, and I paired it with the other one because it's talking about the same thing. It's about restricting your access to relevant information about an applicant. Now, in this case, it seeks to limit the eviction records you can look at as being only those that are less than 7 years old, and that the tenant was found, a decision was made for the plaintiff and not for the tenant. So if the tenant won or it was dismissed or withdrawn, that wouldn't appear. And this has been an issue in the past for tenants who have those sorts of records, right? They've had a landlord-tenant complaint filed against them, but it didn't end up being found that they were at the wrong. No judgment was made against them. Well, that filing being there has served to tell future landlords, hey, maybe this person is too risky. So there's been a lot of arguments, kind of like, we should only be considering guilty convictions. It's the same logic. And so I don't hate this. I've actually made it my process here to only consider eviction records in the last 7 years. Now, all of that's informed by what's been considered reasonable and business related by all kinds of federal institutions. And I've just gleaned that when judges say reasonable, they're going to pull from these policies. And that's why I'm only looking at the last 7 years. And so this legislation, it has reached the Senate. It's in the Judiciary Committee. Um, so it's cleared the House. It's in the second chamber, but it still has to do a whole lot more work to get the full way across the board. Guys, be a nerd like me. Grab the tracker. I'll put it in the notes to this episode. If I don't, I'll forget. Email me. I don't know. Listen, this week, this episode, I get a little bossy like I'm known to do, but I'm really trying to get you to get that financial house in order because I want you to build a wonderful portfolio that provides financial freedom for you and your family. Enjoy the show.
Razzle dazzle, we're the best. No, the courts aren't on your side, but they're not on the tenant side either. Jen, like you are independently wealthy when you are naked. I am over treating property management the same as real estate sales. I guess I'll lead the witness. I think it's freaking scammy. Welcome to Hold It with PM Jen, the show for real estate investors who buy and hold forever and ever. Amen.
Okay, before we get started, the sound quality on this recording stinks. I am a property manager who makes kick-ass Rice Krispies, grows banana peppers like nothing else, and cannot figure out the technology of running her own podcast. So guys, I am not going to re-record this episode. I've got way too much going on. I want you to know that I know the mic had a problem. Most of it's okay. You can certainly hear it, but it is distracting. I am so sorry, and I have authorized my executive assistant, Lindsay, to offer each and every one of you a full refund for every cent you paid for this. You know I'm just kidding. I'm sorry. I will. If you're watching the video, you're going to see the problem. I had the mic on a loose collar, and it got against my skin, and it just like blocked out my voice. So sorry. Enjoy it anyway. Welcome back to Hold It with PM Jen, the show for investors who buy and hold forever and ever. I'd like to tell you a little story to get started today. And it's a story I don't think I've shared on the podcast before, but if you've heard me talk a lot in person, you might have heard me talk about this story. So here in our town in Williamsport, Pennsylvania, we have some real estate families, right? Every town has them, families that through multiple generations, they've done real estate investment and they become known. In this family, they are a name that's on schools, buildings, right? Some of the forefathers of our town who established this town were their ancestors, right? So the gentleman that I'm talking about when this happened was in his early 50s. He was married to his second wife and did not have children with her, but did have two teenage children to his first wife. So like many people, he was co-parenting with some children that were under the age of 18, and he had a wife, and he also had a business partner that he had recently separated from. So he was in real estate. He was in buy and hold real estate. I think when he was with his partner, he had in the 20 to 30 multifamily buildings in our area. And they, of course, had a team and ran all this. And then they decided to separate, the partner and him, and they didn't want to be in business together anymore. So everything got reappraised, split apart, and new financing was put in place for this gentleman and his portfolio of about 11 buildings. And so he was operating his own thing. He went out, he got actually a really favorable appraisal, got debt on everything, kind of not starting over, but starting over a little bit, did some cash out refis so he could do some work on the buildings and get some stuff for him in his life, a vehicle, things like that. Anyway, shortly after the refinancing, he passed away. Somewhat suddenly. This was kind of the case where you have a stomach ache on Monday and are dead by Thursday. And gosh, that's a difficult story to tell for all the obvious reasons, but it gets worse for his real estate business. And I tell you the background of this family because the intention of these properties were to pass down to his children, to continue this family legacy. But the children were still minors. So this gentleman passed away in March of the year he died. And what's significant about that is that he had a lot of student housing. So he was doing the traditional fall and spring semesters with some summer occupancy. But what's significant about March is that's heavy leasing season. You're working really, really hard, at least at this time and at this school in our market. That's what was going on. You'd be working really hard to fill those doors for next year. And so this investor passing away somewhat suddenly in March was really important for the continuation of the portfolio because, of course, that meant it wasn't going to be properly occupied for the next school year. Once the students leave campus, it becomes very difficult to over summer get those units filled. So once the dust had settled from this gentleman passing on, the executor of the estate came to me, and the executor was somebody I was working with and knew, but they were older. And they came to me and we immediately got the properties under management. This meant I had to be in this investor's office going through, oh my gosh, and he used a Mac, and I'm a PC girly, because I've been in business since the 1900s. So I had to figure out how to navigate on a Mac in order to find all of his records. And like many people, he didn't keep great records. He kept a lot of it upstairs in his mind. So I put everything together, got it under management, got the units filled, dealt with the move outs that were happening. Because again, this gentleman passes in March. By the end of April, beginning of May, we have students leaving for the year. We have security deposits to figure out, roommate switches, all kinds of things. And so we take all of this over and we start running it. And by the end of that summer, I realized that this portfolio can't support professional management. What it supported was this investor doing work like a lot of investors do, under the table, working with contractors who didn't make a lot of money, who took a lot of management, but were perfect for working with him. And he did a lot of business on his personality. So he was very gregarious, very charismatic, and did a lot of business on that way. And so when I started putting our expenses, started looking at the debt that the portfolio was carrying, it wasn't as if this investor made a series of bad decisions that meant his business failed because of decisions he made. It failed because he didn't have enough contingency plans for running it the way he was. It ran just fine the way he was running it. It provided for him and it was solvent. But with professional management, it simply didn't. Doing things the right way, doing things above board, and of course, having professionals who cost anything. And the reasons for this are the overambitious lending that he did in the split from his former partner and the reliance on these low cost 1099 subcontractors. All of that made it work for him, but when we weren't able to use them anymore and had to support it and the debt, it didn't work. So I went to the executors and I said, listen, we all understand the common goal here. And the goal at that time was to keep the properties stable, performing, as low risk as possible, until which time the heirs, the children of the investor, were old enough to take it over. And at that time, it was a time horizon of 5 to 10 years. The children were just going off to college, and one had some military service they wanted to do. The other, though, felt like they might come back after college and want to operate these. And so we saw, as a management company, our role was to protect and preserve this portfolio, keep it going so that the heirs could come back, take it over, and live like previous generations had in this family owning and operating real estate. So because that was the goal, I understood that we weren't going to make it 5 to 10 years with this imbalance of income and expenses. And so I went to the executors and said, listen, we need to make some changes here. And we made a lot of changes and figured things out. We actually had to go to forbearance at the bank. And this is a longer story I'll tell at some point. But my point is, this investor, if they had this checklist I'm about to go through with you, they would not have been in this position. Their family would not have been in this position. Now, the end of that story is the family actually lost these properties. It kind of goes on a winding road from there, but you can see it all started out with a lack of preparation. And I would say financial discipline that this investor showed. And so I have recently published, get your financial house in order. So if you're on the newsletter, you've seen this. If you're on my social media, you've seen this. My aim in this is to help tell both new investors and experienced investors. There's a couple of things you need to do from like a foundation first perspective. Oh, that's the name of my friend's company, Foundation First. But putting your foundation first, building that strong foundation so that what you're building will not collapse. Now, this list could get a little preachy, me scolding you, telling you things you need to do. So I'm going to make sure to tell you why I'm so passionate about this, the stories I've seen happen to others, And then I'm going to give myself really honest grades on how I'm doing as an investor on these things. All right, let's get started. The first segment encompasses 3 things that I want you to be doing to protect your access to debt. So we're going to freeze, monitor, delete. We're going to freeze our credit reports at all 3 credit bureaus. Now, I'm not going to get into what all freezing is. That's something you can easily look up or AI can fill you in. But you should keep your credit frozen at all times, at all times. And then only unfreeze it when you need to, when you're pursuing financing. So when I'm buying a property and I get it under contract and I go to the banks and figure out which bank I'm going to go with, I tell them my information, and then when it's time to pursue application, I find out what bureau they're going to go to and when. I will unfreeze it for just the amount of time that they need to get in there and get what they need, and then that's it. And remember, often there's a credit pull closer to closing, and you'll need to let your loan officer know, hey, you'll need to let me know in advance so I can unfreeze it for you, and then it can go back to frozen. Now, when you freeze your credit report, there's a PIN associated with that. I want you to keep that PIN so freaking secret from everybody. Now, oh, what about my kids, my spouse, my accountant? I'm going to argue everybody. Now, in my personal relationship, I have the pins for both of us, but I'm the one who's freezing and unfreezing credit and doing all these financial things. But that's a huge place of trust my husband has placed in me. And I would argue I would never give my pin to someone else to allow them the access to open and close my credit. But you make the right decision for you. Now, the second part of this is we're going to put a freeze on it, but that doesn't mean we can put it out of our mind. We need to monitor that report regularly. So, lots of different ways to do this. So much easier than it used to be. You can still do it this way. This is the way I did it in the beginning of my career. I went to annualcreditreport.com. Now, annualcreditreport.com is the website from the government that talks about your right to have that annual credit report, not the score, just the report from all 3 bureaus. And it used to be I would set my calendar for every 4 months and I would check, Equifax, and then 4 months later TransUnion, and then 4 months later Experience. And that's how I, throughout the year, would keep an eye on my credit. Now I'm using, several of my credit cards have credit monitoring services. And then I use like a Credit Karma, I think it's Credit Karma, to dip in, to actually look at the report, keep an eye on the score and any new transactions, trades, or inquiries. So I'm watching from that perspective because if something goes wrong, I need to fix it right away. And the last part of this is controlling personal information about us that's available. Now, a lot of us are using LLCs, right? And we think that gives us so much anonymity. Newsflash, it really, really doesn't. It's very easy to find out what address your LLC documents are going to, line up property ownership records, and boom, not only do I know who you are and where you sleep, but I know all the real estate that you own. Ask me how I know to do that. I do. So I've gotten really ambitious about getting all of my personal information offline. As I build a public profile, as I buy more properties, as I do a lot of things that get attention and might attract people to mess with me, I've decided to reduce how much information is available. And I've done that in a lot of different ways. But one of the easiest ways is I use Delete Me, deleteme.com, but there's a couple different ones that actively will go out seeking out your personal information on these they're database sites. So they figure out your name, your age, your phone number, your email, your address, and they're just putting that out there again and again. Now, I have a pretty unique last name. There's not many of us in the US. I think this is a bigger risk for me than many others. But if we're interested in protecting ourselves, our information, this is where we need to go. So all 3 of these things are about protecting your credit, protecting your reputation, protecting your name. You want to make sure you are in control of all those things because you make your living, well, if you're full-time in real estate, but you make your money on debt and your access to debt and the control of your debt. And so I've just seen it happen too many times. An investor with somebody in their family or friendship group that's maybe suffering from substance abuse feels for them using their identity, using their credit. Partners, husband and wife or partners who are in conflict with each other can mess with each other's credit doing these things. And I've seen this happen to people I know and work with. And that's why I'm so passionate about it. So let's grade myself. Well, I'm giving myself a C because I kind of believe that I don't kind of, I really believe that we're only as strong as our weakest link. So I'm getting a C. Now, listen, I've had my credit frozen for years and have only unfrozen it when I needed. Like, I thought that was going to be a huge pain in the ass. It's actually not. Even for somebody who's like me, who's regularly pursuing debt, doing things with debt, it's not that big of a deal. Monitoring my credit. I'm giving myself a B on this. I am monitoring it with all these different services. So I'm keeping an eye on the score, but am I going in every month and looking at the details in the trades? I'm not. And I'm going to, a little note to myself, I could be doing that better. I'm sure it's boring. I'm sure I'm not going to find anything, but I should be more active in that. And then, the last one, using a service that deletes your information online. I told you I am a customer of Delete Me, and I enjoy that service. Listen, it's priced at the highest amount that I'm willing to pay, but I've decided it's an investment in my safety. I've done it for myself. I've done it for my immediate family. Basically, if you carry the name Rulins and I know you, you are on Delete Me. And I'm giving myself a C on that because I waited way too long. I spent years building a profile online, being a landlord of 600 plus doors in a small town. Having my information out there like that just wasn't smart. And I let it go too long. And the thing with services like Delete Me, it can take up to a year for them to fully be able to do what they need to do to delete you. And so I'm only about 6 months into that journey, and I'm seeing the effects already, but yeah, that's what I would share with you about that. This next section, I'm calling it Keep Your Money Honest. And you're going to think I'm harping and asking you to do a lot of work over a very small thing, but I promise you it isn't. So the first thing is monthly reconciliations. I need you to treat the first of the month like an alarm bell's going off. My bank statement's ready. My bank statement's ready. Go get that bank statement. I want you to review it personally. Look at it, review it, look at the cleared checks, look at the balances. Great. Now you need to go reconcile your accounts in whatever software, if you're still keeping a checkbook register, whatever it is, reconcile the accounts. Now, why am I arguing you need to do this personally and you need to do this right away? Well, one, I want you to have an eye on your money and what's happening. I want you to see the cleared checks. I want you to check signatures. The bank isn't doing that for you. I come from personal experience on this. Additionally, I want you to find mistakes early and fix them quickly. We should not find out that, oh, for the last 18 months, I've been being billed for trash that wasn't even, on auto pay that I forgot about. And it's been coming out of my account. And now I got to try to get it back. I just was reconciling my HSA account actually this morning and saw that 2 payments that I indicated that I made online to a healthcare provider weren't actually executed in the account. So now I have to go find out, hey, I thought I sent this money for this account to pay this bill and it hadn't gone through. I'm checking on that before the provider comes to me and says that there's a problem. The other part of keeping your money honest is I want you to keep your business and your personal accounts completely separate. And you're going to go, Jen, I do that. I have a bank account for my LLC. Don't you worry about it. Do you have separate credit card accounts? Do you? Do you make sure that nothing ever crosses in between? I want you to think about this piercing the corporate veil because it is a huge and scary thing if that liability veil is broken, right? We think about the big scary court thing. Something happens on the property, there's a liability claim, and now somebody sues me and, oh, I have that in ABC LLC. So the only things exposed should be ABC LLC's assets, but the corporate veil has been pierced because I commingled funds or did something like that. Now my personal assets are available for seizure in this liability case, but so are the assets of my other LLCs. Likely. I mean, this would all have to be investigated and things. And that's a big, scary thing that should scare you. But I'll tell you, you Probably haven't met anybody personally who's had to talk about that or do that in front of a court. However, when you commingle funds, there are some very real things that happen that make your life a lot more difficult and your business less successful. The first one is you can't tell me if you're making money or not. If you are commingling funds, you have bad information. You could be saying, hey, well, this happens. People tell me, yeah, my rental, they pay $1,500. My mortgage is $1,200. So I'm cash flowing $300 a month. No, you aren't. But if all you ever do in that LLC bank account is pay a mortgage and put rent in, you could confuse yourself and think that you are. Where's the insurance coming from? Where are the taxes coming from? Where are the repairs costs coming from? Everything to do with that is now commingled, and you can't tell me what you're making or not. And it only gets more complicated the more properties that you own. The second thing that gets more difficult is that financing gets harder, right? Because when you go get financing, you're showing them the performance of your business, your personal finances, whatever it is. Clean financials are less risky. Clean financials will present information better and will be perceived as less risky by the bank. Another thing that gets trickier is partnerships and investors. So if you're doing JV deals, if you're doing LLCs with other people, if you're taking on investment, keeping clean financials becomes even more important because when things go wrong there, it's going to get really expensive and really messy. And the last thing that it affects is your taxes. I argue that taxes get more expensive and more risky when your financials aren't clean because you've commingled things. It's going to take more time and more expense for the CPA to untangle it and do your filing. And you could miss legitimate deductions. You could claim deductions you can't back up. The point is, when you make that decision to commingle, it's usually a decision for convenience. It's, oh, I forgot that checkbook. I'll just do it from this, or oh, I'd rather just do this and then move the money. Whatever your reason, it's usually based in convenience, less time, effort, whatever. And when you make those decisions quickly and out of convenience, you don't realize the risk you're taking and the consequences that you're exposing yourself to. I'm going to grade myself on this. When it comes to monthly reconciliations, I get an A+. I am eager beaver on the first to get those statements, open them up, review them. I do daily reconcile in QuickBooks Online for all of my businesses. I open them up. I see what things have come through. I'm not in the bank account on the bank's website every day. I'm using the auto feed into QuickBooks for that. And then I use a third-party external reconciliation service, not just for the trust accounts, but also for our other accounts here at OneFocus. And so I'm eager. I check their reports. I look at each transaction on, or the check transactions. I actually see the images. But I, as you know, if you listen to this podcast, had an embezzlement, almost 10 years ago. And since then, my practices there have been awesome. All right, let's talk about commingling funds. A year ago, I would have told you A+. I don't combine anything. Like, I pay myself a salary out of OneFocus. I've never even accidentally used the company credit card at like the grocery store. However, I went to a Rich Dad, Poor Dad event. I actually got to meet Robert Kiyosaki last year at Penn State. Thank you, Prof. M. She's one of our sponsors with her Inspire Wealth education and consulting. She's doing courses for investors. But all that to say, she brought Robert Kiyosaki and his Rich Dad, Poor Dad advisors to Penn State. I got to see them speak and I got to chat with them a little bit. And I spoke with, I'm going to say it was Tom Wainwright. I'm almost positive it was him. But one of the Rich Dad, Poor Dad advisors, and they talked about this commingling of funds and the danger and all that. And I said, but wait a minute, you mentioned credit cards and I have an Amex Platinum for OneFocus. I said, I use that credit card to book my personal vacations because of the automatic travel insurance it comes with. And then I turn around and I write a check from Jen Personal into the Amex and pay it. And I said, could that be viewed as commingling funds? And he said, yeah, it really could be. And I went, oh my goodness, I feel like I could be doing that better. So I am going to give myself a C on that because I think I'm a C compared to other people, which means this whole thing, I'm getting a C. And I'm being very honest with you guys because I really like to get days. Okay, let's talk about insurance, the bet you hope you never have to collect on. And you're going to hear these suggestions and go, nobody, Jen, has time for this. And you're right. Nobody has time for this. Nobody's doing it. And they are suffering the consequences. Those of us who do it are immune from the consequences. So let's talk about it. I have 3 things when it comes to insurance. I want you to be doing an annual insurance review with an insurance professional. Now, this is not, generally speaking, just a State Farm agent, right? You are a business owner. You're hiring people to do work. You're doing all kinds of stuff. I want you to be talking to a business insurance expert. If you're not making a lot of moves and changes, maybe every year is too much. But if you're doing transactions, you're engaging in new kinds of business, you're taking on new kinds of projects, I think at least annually, you need to be meeting with your insurance expert, talking about your policies, the changes, your business, your life, everything that's changed in the last 12 months. That's a big deal. But that story I told you at the top of the episode, the one where the gentleman took out the loans for his buildings and he's operating them. If he was talking with somebody in insurance, they would have said, hey, let's talk about some life insurance here that will help address the debt on these properties should something happen to you, because that is a real failure in your plan here. And it meant, as you learned, that those heirs did not get those properties. Let's talk about the other insurance you need to be working on, which is your tenant's insurance and your vendor's insurance. So you need for every single tenant to verify that they have renter's insurance that meets your specifications. So if you want to say it has to be a certain grade provider, a certain amount of liability coverage, I don't think you should really dictate the contents coverage, because it's their contents they're protecting. That's entirely up to them and whatever. But liability, you might say 100,000, whatever. I saw somebody out there talking about how the liability had to match the value of the property. Talk to your insurance agent about that. But if you start dictating levels that are pretty extreme and beyond, I'd say $250,000, you might be looking at some, raised eyebrows from a judge if you try to enforce that. So some examples of where that came in handy. We had a 6-unit fire a couple of years ago. This is a 6-unit building, and there was a fire on the top floor. One tenant actually jumped from the 3rd floor. She survived. She was fine. But that building wasn't able to be occupied for well over a year after the fire. And it was so comforting to know when the American Red Cross showed up, when the owners were there, that I knew every single one of those tenants had renter's insurance. So I knew that if they caused it, there'd be some coverage for that. I also knew that if they needed anything protected of their personal belongings, moving costs, that sort of thing, it should have been included in their renter's insurance. That is always a relief when I get this very anxious call from a client or something going, and do they have renter's insurance? And because of the way we run One Focus, I can say, yes, we have an audit process that makes sure that we keep them on. Another example, this came in really handy, and gosh, I have a bazillion, but we actually had a family where they gave one of those, I don't think it was exactly a hoverboard, but it had that lithium battery pack. Gave it to the kid for birthday or a Christmas. It's in the living room, and in the middle of the night, the darn thing sets itself on fire. We've heard these stories. And so thank God everybody was okay, but we had fire damage in that property. And we were able to work with the tenant's insurance, the property owner's insurance, and get this all settled out. It wasn't as if the tenant had liability that they weren't going to be able to meet. Their liability was covered by that policy. And then your vendors. So you're going to hire somebody to mow the grass. You're going to hire someone to clean the furnace, to put a roof on. All these things are activities that you need to make sure that they're going to be working on your property, that they're properly insured. Now, what kind of insurance? Well, for sure, general liability. But you might want to check to see if they have workman's comp, if it's more than just a sole proprietor. Because remember, if somebody gets an injury working on your property and their boss at the company doesn't have workers' comp, they can come after you for that coverage. If you know that and understand that, you'd be checking this insurance when we work with people. I know that when I hire people personally at my house to do work and I ask them for their proof of coverage, they're often thrown for a loop until I explain to them that I'm a property manager, so I understand this. And so, but they get it right to me, and it's been absolutely no problem. One example of how this really came in handy, we had some roof and gutter work done at a property by a roofer. And shortly after the roof job was done, we got a leak inside. And it was something that was done wrong in the roof install. So we are trying to work with the roofer to get this fixed. And of course, to fix now what is damaged. There's some damaged drywall inside. It's nothing crazy, but it does need to be done. And this roofer, we had used them for other jobs, not a ton. They were somewhat new to us, but they decided this level of conflict and accountability wasn't for them. And they decided to ghost us. They blocked our numbers. And we were really flummoxed. I mean, we went out and found this vendor for our client, and now our client has this problem on their property. What are we going to do? Well, we went to the insurance company and they had insurance that would cover the work that they had done. If it was faulty, we were able to work and make a claim on that insurance, get the money to pay a new contractor to finish the job and finish it up. Now, I'm guessing that contractor is never going to be renewed or rewritten, was probably kicked off the policy with that insurer, but that insurer did what they were supposed to do. And because we had proof of that insurance, we were able to make that client whole and get that done. Now, that's a lot of admin, a lot of work. There's a lot of dependence we put on insurance, and we're just woefully undereducated about it. You are your only advocate in this, and I want you to be really, really exact about it. All right, let's grade myself. I'm actually giving myself an A+ on all three. I do an insurance review annually, but that discipline was brought to me through One Focus. So, of course, we have several insurance providers, and I do insurance reviews with them every year because these are sizable policies. I'm spending a lot of money on insurance. And now I've just taken that discipline and done the same thing personally. I talk to the insurers of our cars, our life insurance policies, the house, all that stuff. We're talking about that, about the changes. Now, admittedly, there's less changes in my personal life than there is in the business life every year. But my business life or my personal business life, like my personal investments, are starting to catch up to the regular business life with the properties we're buying every year and adding complexity. So, and then when it comes to tenant and vendor insurance, I'm also giving myself an A+. We are 100% on that here at One Focus. And I know that because of the processes we run and the audits that we run. So we're having to run audits all of the time in order to keep those systems running. From experience, if you don't do those audits, things will slip. I'm just telling you, it is a lot of time and energy to be able to deliver the low risk experience that our clients expect here. This next section is all about preparation for the future and putting things in writing before you need it. And the first one of these is no surprise. You've heard me do podcasts on this before. I want you to have a will or trust or something set up. Do your estate planning. Make this easier on your family. Take notes. Let them know where to find things. Give them passwords. Give them the keys. Keep your keys well labeled. Keep your files well labeled. Think about if something were to happen to you, what would your family have to do in order to get the value of this work that you put in that intends to serve them? And so having real estate complicates estates. It complicates your will, your trust, all of it. And if you're building this for financial security for your family and you care about them, then you need to have a plan and review it with them regularly. You also need to review it with an attorney who specializes in estate planning. We don't take the will or the trust to the one who helped us with the divorce, to the one who helped us with the DUI, to the one who did the last property closing. We go to a specialist. That world of estate planning changes very, very frequently, and you need to be talking to somebody who's doing that work all the time and then review it frequently. One thing I do on this is I actually have an in case of emergency document. It's kept in the safe with the other important documents. The two important people in my life that are going to be handling everything should something happen to me know this. I remind them every quarter. So at the beginning of every quarter, a reminder comes up in my computer, my calendar, and it says, "Hey, update the in case of emergency sheet, put a new copy in, and remind your two people that that's where it is." So every 3 months, these two people get a little text from me. "Hey, just reminding you, if anything happens to me, you want to go to this safe, blah, 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 blah." And it's in there. And it's just a one pager. And I literally go, "Hey, you're going to access my password manager this way. Here's the legacy contact for my phone. Here are the bills that kind of come in and I pay every month for us as a household, things like that. Where do the bills come from? Where does the money come from? Who do they need to call? Who's the attorney? Where are things?" It all fits on one page. And this is something I look through and update when I buy new properties. I have to go, "Oh, there's a couple more obligations to add to this," or loans or whatever. And it's not everything. I didn't take a ton of time, but I have done various things like password managers, legacy contacts, wills. So really, this document just helps ease them and get them into what they need to do to keep things running. The second part about this is your operating agreement. So operating agreements, they can be called different things, but this is the document for your LLC, your business entity, that explains who's a member, how does this run, who has what authority. And so in my role as a property manager, I have to verify the ownership of property. So I interact with my clients' operating agreements quite a lot. And I'm shocked at how unprepared they are to use those documents. So I don't always believe they're following those documents. Follow me on this example. Maybe some members of a family, a couple siblings, a parent, an aunt and uncle, whatever. A family group of 4 people get together and start an LLC. And they're buying real estate and doing various things. And over the years, we all forgot that when we set this up, we put the 2 most senior people in this group of 4 as the only people who could engage business for the LLC, to sign the property management agreement, to sign loan docs, that sort of thing. Well, they've been hiring landscapers, remodelers, all these people, all 4 people have been doing it. Well, now there's conflict. And the fact that one of the 2, I call them senior and junior, one of the non-signers has been signing and doing business could expose that investor to all kinds of trouble and the LLC to a lot of trouble. I just had 2 cases somewhat recently, 2 clients I was working with that I wasn't able to sign because of their operating agreements. Now, one of them, after some searching, found the operating agreement for the LLC. It has everything in their partner's name, who I've never met, and the document was unsigned. And so I said, "Well, I can't actually work with this. And in order to work with you, I'm going to need to meet your wife, to ID them, to, check their ID to their image. And then this document has their name on it. I can then match them to this document. And then I will need them to be the one to sign papers, give us instructions, and that sort of thing." That I don't believe is going to work for that investor. The other example of this was a married couple who'd bought some properties and now they've separated. I don't believe they're actually divorced, but they are not getting along. They're not speaking, but they still have these assets in this LLC that they both own. So the husband of this couple is attempting to work with me. And I said, "Well, let's get the operating agreement together. I need to see who's on it, blah, 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 and the control and who signs." Well, he says, "Well, we don't have an operating agreement." I said, "You need to have an operating agreement. You needed it to get loans, to do these transactions. Find it." I don't believe he found it, but I do believe he and his spouse made an operating agreement and presented it to me. But in this operating agreement, it had the spouse, not him, the spouse that I hadn't met and wasn't talking to, as the decision maker, as the one who had to sign everything. And I'm speaking with my hopeful potential client about this and saying, "Well, we need her to sign off on this. Same thing I just told you with the other one." And of course, that spouse is refusing to participate in this process. And I understand they have a whole thing that they're going through there, but you can see how not having and treating that operating agreement for exactly what it is the birth certificate, right? It establishes the life of this entity, how it's going to end, how it's going to operate, everything. And I think People take that way too lightly. They don't understand the purpose of that document and how they need to have it. All right, let's grade myself. Having a will or a trust in place, I think I'm doing A plus, especially for somebody in their mid 40s. I've just seen enough in my career to know, yeah, you need to be prepared for the inevitable. Um, yeah, I guess it is inevitable. Your death or incapacitation is inevitable. It's coming at some point. And then my operating agreements. Yeah, I'm feeling good about that. Um, I could probably review them more often, but they're all the same. They are set up more traditionally for a two-person LLC where we're kind of both even in this 50-50, where some of these others I've seen aren't quite like that. Two more sections, they get juicy. All right, this next one, this is all about your money in reserves, your capacity to withstand um, trauma, changes. And so the first one, the first part about that though is knowing your loan terms. Knowing your loan terms is so vital. You spend all this time thinking about this property you're going to buy. You go out, you secure the financing, and from that point on, that loan becomes a payment number to you. Oh, it's $1,523.17, and it comes out on the 17th, right? From then on, that is kind of your relationship with that loan. At any given time, if I ask you, when does that loan mature? Are the rates going to change? You wouldn't have probably a big idea, particularly if you're in deep and you're doing multiple properties. And so I want you to know your loan terms. I want you to know, and you don't have to know them cold, but you have to review them somewhat regularly. A good way to do this is make this part of that process we just described about making maybe like an emergency thing. I have a list of loans on there. It has the loan number, the maturity date, the payment, the balance, and if it's fixed or flexible or, adjustable. Now I'm reviewing that every 3 months and I can say, hey, this one's coming up for maturity. Hey, the interest rate on this one is starting to get out of line with what I can maybe get on the market. Hey, I've got a rate adjustment coming up in a year on this. How threatening is that? Do I need to look for alternative financing or do I want to reconfigure my debt and equity? That's part of your job as the investor. And I think you need to be regularly reviewing and being very familiar with your loan terms. If you don't know your loan terms or have them easily accessible, making decisions gets difficult. When am I going to be getting that balloon payment coming? Should I be putting more against the principal because I'm having a good quarter? All those kinds of decisions are only really made possible when you know your loan terms, the parameters you're working within. And then cash reserves. And I say cash reserves, but I just really mean funding access. Like, how accessible is money to you should you need it? And by need it, I usually mean the money that the properties ask for occasionally. Sometimes they're going to have a longer than normal vacancy. Sometimes you're going to get a tenant who does a bunch of damage you weren't expecting. Maybe we'll get a boiler that needs to be replaced earlier than we had anticipated. And so having cash reserves, literally for some people, that's just a pot of money sitting there. They make a calculation off the rent roll and go, great, I keep 5% of my rent roll in cash reserve. Or I keep $30,000 per property. Or whatever your calculation, I want you to be thinking about that. Now, it doesn't just have to be cash. I mean, keeping cash right now isn't the worst thing. You can get like 4 or 5% out there pretty easy and keep it liquid. But I know when I started in this business, keeping cash around wasn't the best idea in the world because, your ability to make interest on that was so low. And so I've seen investors my age who were exposed to that environment start to combine a couple of different ways that they do this. Some people for each property will have a line of credit put on it. So when they buy a property, they get a line of credit attached to it and they treat that like a reserve. I know other people who have, several properties and they kind of keep a minor line of credit on each and then a cash reserve that's meant to serve them all. There's all different ways you can go about that. But the thing I don't want you to be doing is using your credit cards as the reserve. And there are many investors doing just that, going, well, I have a $20,000 account with Capital One, and I can use that if I need it for the property. That is not the thing that would not be my first plan for funding access. I'd be working on a combination of line of credit and cash reserves. I am giving myself a C on this. Now, I'm giving myself an A on knowing my loan terms because I do. I am very familiar with my loan terms. I know what they are. And actually, I'm managing my mother and father's estate now, and I'm doing the same thing for their loans that are on their properties. A lot of loans to keep track of, but that's the business. That's the job. Now, my cash reserves, I'm going to give myself a C. I do not have lines of credit set up like I should. I need to be doing that. I need to be treating that like um, something I just do when I buy a new property is I establish the line of credit for it. I have not done that. So I do have cash reserves and I'm fine with that. But I'll tell you, I'm pretty ambitious about buying new properties and I'd like to use that cash on those properties or buy them seller financing and use them to improve the value of those properties. So I like to keep my cash working and yeah, so I like a hybrid approach, but I'm giving myself a C because I'm not all the way there yet. And now the last section I want to talk to you about, it's about your people. And I want you to have an incredibly professional team identified and ready before you need them. Now, listen, I do not think that you should go out and have interviews with all different kinds of people before you ever buy a property. No. You should be meeting people. You should be talking to, at that stage of the game, you're talking to other investors about who's on their team and how they found their team, lessons that they've learned. And you're going to be starting your journey and meeting people. You're going to meet lenders. You're going to meet realtors. And you're going to probably meet some contractors right off the bat. And as you get further into your journey, lawyers, property managers, they're going to start to come about. Insurance agents, that sort of thing. I want you to think about a couple of things when you're finding these people. Oh, and I'll give you the list. The core list for the team has to be attorney, real estate attorney, by the way, realtor, CPA, insurance agent or agents. Having just one doesn't usually math for me. Property manager and contractor. Hopefully, I'm the property manager on your team. You've either hired me or I'm your property manager expert. You're listening to me. I'd love to be on your team. A couple of things when you're looking for folks on this team. I want you finding people who have a declared expertise in real estate investment, or they happen to have a lot of clients who are operating real estate. The difference is people who can do something and people who really do it. And the people who really do it all the time, who specialize, who have expertise, they are worth so much more than anything they charge. They're the people who see change coming on the horizon, call you up and say, hey, adjust course. You've got something coming 10 clicks ahead. Uh, those are the people who need to be on your team, not your cousin who's a lawyer who's happy to take your call once in a while on a random question, not your cousin who will guilt you if you don't use them for the transaction. We should be seeking people who are experts. I think expertise is so important because I experience the lack of expertise every day. You know, clients or tenants, maybe they have an attorney and they want to review my lease or my property management agreement, which is fine. Everybody should have anybody they want review and explain and help them negotiate. But when I get a lawyer red line property management agreement back to me and it is asking me to do things that I cannot legally do under my license, it lets me know that this person, while they are an attorney and they aren't thinking about the best interest of their client, they're actually not aware of the rules. And so I have to do some soft education back and help them understand the nature of this, that what they're concerned about is understandable, but this is how we address it. That's always frustrating. And the same thing with insurance agents and accountants. I talk to a lot of insurance agents and accountants who do not understand how real estate investment works, do not understand the players, don't even understand what I as a property manager do and how the finances work that way. And so it's my argument that if you're getting professional advice from someone, they need to know more about it than you. So we need somebody with deep, deep expertise. Same thing with being out of market. I think when it comes to things like the realtor or the lender, you should maybe prioritize some in-market stuff. So when it comes to a realtor, I think it's obvious. Expertise of location and how things trade in a market is one of the things these realtors bring. And I get it. Maybe you're from an hour outside this market you're investing in, and you have an agent that you love, that you trust, that has done such great work for you all over that market. But I'll tell you from experience, when I'm working with investors with out of town agents, They are missing so much. They are missing. Yes, they can do the transaction. Yes, they can negotiate for you, but they can't give you any kind of information about the value or operation of that asset. So for those trades, oh, and for lending, small community banks, I still think are the investor's best friend, although they're dwindling and we're having to get more familiar with larger institutions and the investment products they're offering. So those should be local. However, I think sometimes you have to go out of market to find expertise. For instance, in my small market, I don't find lawyers and accountants who are really deep in the expertise of this. So I will go out of town. I'll use people from Harrisburg, from Philly, from Pittsburgh. I want to stay within my state, but I want to work with people who are doing a lot of work in this all the time. And they are, like I said, out on the horizon, looking ahead, telling me what's coming up. Now, once you have this team assembled, the most important thing you can do is use the team to prevent incidents. So you're thinking about doing something new? Go and pay the $100 for the 15-minute conversation with the attorney to talk to them about it. Get that on their radar. Hear what they have to say. I've done this a lot. I have a lot of new ideas all the time, and I love talking to these people preventatively because I can get the information earlier on in the process. Let's grade myself. My team's an A+. Now, I'm in a different situation. When it comes to my property management team, that's what I sell. So I, of course, have put together the Avengers of contractors, of property managers, insurance, anything to do with properties in North Central PA. I have the best, have hired them, have fired them, have met their competition, all of that. It's actually not that hard in this small of a market to know and get the best of all of those. When I select those people, I prioritize expertise, working well with me or my company or whatever. I prioritize responsiveness. I don't want to be sitting around waiting for messages and answers. And I really want confidentiality. I think confidentiality is a very overlooked part of fiduciary duty. And for somebody who's always telling tales out of school online, I keep these things anonymous. I keep them general. You can't tell who I'm talking about. I find in my small market, I like to do my personal business out of town. So stuff to do with One Focus, stuff to do with me personally. I don't often trust the lawyers, accountants, and whoever to keep my information confidential. I also wouldn't trust the people I've picked if I was in their social circles, seeing them at the club at Christmas and things like that. But the thing is, I'm out of town. Nobody there knows me. So I feel a little bit safer in that confidentiality being kept. So my team here at One Focus, I'm giving myself an A. And then my team personally, I'm also giving myself an A+. And it's really come around in like the last 3 years where I feel like the team is complete. I have strong players, and as long as nothing crazy happens, I'll be working with these people for the next 20 to 30 years easily. So I've given you a checklist. I am going to go through these 13 items again, and I want to implore you, if you're new, treat this like I'm going to be doing this over the first, couple years of my journey. If you've been doing this a while, be honest with yourself. After each one of these, give yourself a grade and think about the risk that it exposes you to. And if that's compelling, I know it's boring and unsexy, but I want you to fix it anyway. All right, rapid fire, 13 things. 1, keeping our credit frozen. 2, monitor your credit regularly. 3, delete your information online. 4, reconcile all of your accounts monthly. I didn't mention credit cards. Reconcile those monthly. Do not commingle business and personal accounts ever at any level. Be really anal about it. I want you to review your insurance coverage annually with at least one insurance expert, maybe even 2, because you got to compare them against each other. Check every single tenant's renter's insurance and make sure it's in force and you're additionally insured or additionally interested. Check vendor's insurance. You may be able to get yourself listed as additionally insured on that, but at least make sure that they have their liability and workman's comp policies. Next, I want you to have a will or a trust in place, some emergency protocol to help your family out. You need to keep your operating agreements accessible, current, and know what's in them. That is like the birth certificate for your business identity. I want you to know your loan terms, review them regularly, know which ones are going to mature soon, sooner or later, whether they're adjustable or fixed, what the payments are, all of it. There's prepayment penalties. Knowing that information will give you the information you need to make better decisions. Maintaining your cash reserves. Keep those cash reserves in check and have that professional team ready before you need it. And oh yeah, here's a bonus 14th one for making it to the end. I want you to get a lockbox or a keyless entry for your properties. I am still meeting people in 2026 telling me the keys under the mat, the keys in the mailbox. And if anybody has accessed that property and that property is visible to others, know that somebody else knows that that key is there and accessible. It's a very dangerous place to be. We're all scared of squatters, so just get the lockbox and the keyless entry. You didn't want to hear it, but I had to tell you. I know you don't want to do it, but I need you to do it anyway. And if you don't and you get hit with some consequences, I am not going to feel sorry for you. Real estate folks are the kind of folks who take care of things and make sure that everything is right. And that is what I want you to do. Help yourself. All right, enough preaching. Let's buy and hold forever and ever. Amen. Until next week.
You know what's better than building generational wealth? Not a damn thing. And obviously the best way to do that is through buy and hold real estate. But let's be real, managing your properties yourself, that's a one-way ticket to burnout. This is supposed to be an investment, not a burden. At One Focus Property Management, we don't just manage your properties, we make buy and hold real estate actually work. We handle everything: tenant screening, maintenance, rent collection, you name it. All you do is watch your portfolio and net worth grow. We make sure you never even think about quitting real estate investing, because the secret to buy and hold is to hold it for a very long time. And you can't do that when you sell every time you have a problem. We're the biggest, baddest property management team in Lycoming, Clinton, Northumberland, Montour, and Columbia counties. And we do it all to give you more protection, less work, and absolutely no drama. So let's turn your rental properties into wealth-building machines. Learn more at onefocusPM.com. That's onefocusPM.com.